So, Samir, nobody knows what's going to happen, right? The one thing we do know is that risk sentiment is off. Strategists are lowering their growth forecasts. They're lowering their forecasts for the S&P target for the end of the year. And the possibility of stagflation is creeping ever closer to reality. What do you do here? Do you decide that this risk sentiment pullback is temporary? Or do you take a bit more of a sort of an apocalyptic approach?
Well, I think the first thing you do is take a deep breath. And I think you at least appreciate the fact that, again, there is a lot of uncertainty, but the thing is we're all in it together. And so we're all feeling it together. And I think now that we have seen, quite a bit of a sell-off in equity markets, I think the biggest thing for investors to do is not overreact. I think the asymmetry for markets is still higher. Now, our year-end target is on an earnings number of 275 and the midpoint is 6,600. It might be that depending on what's around on Wednesday, maybe those numbers end up being a touch too high. But I would still argue that when we kind of think about risk and reward, I think that it still tilts to the upside. And I think we upgraded mid caps last week, again, with the thinking that, we think that investors should be viewing this volatility as an opportunity.
Well, so valuations clearly changing, as you're saying, but do we then start to view stocks in some areas as quote unquote cheap, or do we have to revise in totality our fair valuations?
So I think from a cheap standpoint, I think if you can buy quality equities where you have at least some semblance of understanding where earnings are going to come in, I think you can step in. I would point to U.S. large caps. I would point to U.S. mid caps. Developed market equities, I think, look a little bit interesting. On the other side of the ledger, I would say, small caps are pretty low in quality. They've had very difficult times with respect to trying to make money, even in the best of times. And then emerging market equities are also something where the sentiment's improved, but they're running well ahead of fundamentals. So I think there's a real bifurcation in markets in terms of who you can trust and who you want to stay away from.
So what is your thesis behind your optimism about large caps, for example? I mean, do you buy large caps indiscriminately, or are there certain areas where you think, they're now undervalued, but they weren't before?
Yeah, so our most favorable sector is energy, and it's the best performer year to date. Our thinking was that, again, the sector had underperformed even really kind of the declines that we had seen in energy commodities. And so we thought all the bad news was priced in. We were right. And so energy's been the best performer year to date. We also like financials. I've mentioned a couple times now that financials could be the eventual leader if tech really does move to the sidelines, which I think is still kind of, TBD. So, tech also probably continues to participate. We like comm services. That's the part of growth that would be our favorite. And then industrials, right? If at some point all the Trump administration's policies are going to result in more, kind of reshoring inside the U.S., you're going to want to own those U.S. industrial companies.
So what about this bid into gold and into bonds then? Is it warranted? Is it short term, Samir?
So we've said for some time that we like commodities as a whole, and within commodities, we like precious metals. So we are not surprised by what's going on with gold. It has clearly been the safe haven of choice. What's interesting to your good question about gold versus bonds, gold has outperformed bonds, which tells you that one, that investors are worried about the U.S., kind of side of things in terms of assets and the dollar. And then two, they're worried about inflation, which we've been worried about that for some time, that the market was a little too sanguine. So for both those different reasons, we would say absolutely have a full allocation to the intermediate part of the curve, and then have a overweight allocation to commodities and continue to favor gold within that on pullbacks.